Hello, everyone. I'm Steve Ankerstar, CEO and founder of Ankerstar Wealth, and thank you so much for tuning in, whether it's live or on a recording later on. The purpose of tonight's briefing is to talk about our investments from quarter 3 of 2022, talk about the forecast for quarter 4 of 2022, as well as beyond, and what your investment portfolio is going to look like if you're with me, or what some changes to think about if we need to sit down and talk about the way forward for you. As you know, this can be a little dry, so I do try to spice it up with some humor. So I was thinking about if I was going to encapsulate what 2022 has looked like as far as in investing, I would be sitting there watching CNBC with all of the bright red. I'd be listening to some Disturbs, Down with the Sickness, this song, if you've heard it. All of which while I'm soaking in some, Dante Inferno just for some fun reading to see what level of hell this actually is. But in all seriousness, from a big picture investing perspective, there will be times like this that are very challenging, very tough for you, the individual investor that's obviously doing something else with 99% of your time than worrying about your investments. But just so you know what, I and my team are thinking about, and I'm very proud of my team for how they've come together and worked really hard this year to not only protect your money, stop losing as much, but protect it from the downside and then reposition ourselves for the inevitable upside, which we know is coming. I did happen to wear uniquely the Alabama vest here because it's kind of like Alabama season. I know we're going to win, but certainly it's a struggle win the whole way. Right. And then there's mistakes left and right. Could have been out earlier, could have done this, could have done that. You can't beat yourself up for what you should have done, but you're looking every day about what you can get better and moving on from there. So that's what you're going to see in the briefing tonight. So thanks again for the 5-day Rolex. I scratched my cornea on top of all the other fun we've had this year. Scratched my cornea the other night, so I really couldn't see on Thursday to give this briefing. So I had to wait a few days for that to heal. Everything's fine. Thank you for those that have checked out, that reached out to check on me. All right, here's how this works. You see the investment advisory board there. These individuals are investors in the firm, as well as give me actual advice on some investments. They have my ear all the time to be able to pitch new things. However, I need to make it very clear, only 2 of them are financial advisors, which are myself and Joel, which means those are the only 2 that would be giving financial advice out to any particular client of Ankerstar Wealth. So a very fine line. They can, pitch me their stuff and, hey, what do you think about this and all that? But only 2 of us are actually client facing as far as giving actual advice. While we're on here, I have everybody turned off. I can't see if there's 1 person here or 500. I can't see if you're chatting because I don't want to be distracted from the message. However, at the end, when I take questions, I'll pull up the chat window. The chat window is your place to either throw spears along the way. That's awesome. That's BS, whatever you decide to say. Or if you want to ask a question, put it in the chat window. At the end, I will take questions and go there. I challenge you because I have not had a question yet. So why don't you be the first? I won't call you by name, but I will read your question. All right. So thank you for attending. Quick disclosure up front. A lot of fine print. What this really means is Ankerstar Wealth is a manager-managed LLC, meaning I, Steve Ankerstar, have the sole discretion over all the decisions that go into the firm. I have sole investing discretion over the entire firm. However, the sub-advisors also have discretion over the particular clients that they work with and the accounts they manage. All of us in entirety are doing our best using the knowledge and the skill set that we have to be able to position your portfolios to make the most money we can while minimizing the downside. Obviously, it's a challenging year for that. There's lots of words that we'll go into here that slowly say that. But basically, we're humans. We're doing the best we can for you. We're very proud of what we do. We've lost less this year than almost everybody else across the board that hasn't just straight gone to cash. So then you'll see that when we talk about the numbers. So as a whole, I'm very happy for individual clients. I empathize with very few individual clients are up. If you're up, you've only been in private equity, basically. So pause that on the disclaimer. If you need more information, go to ankerstarwealth.com. Okay. Here's the vision of the company. One thing that I haven't done as well as I want to, so I have some work to do, and that is that in italics there in that top sentence is rapid response to client concerns. I've been, for those that have been with me, the OGs, if you will, if you've been around for 8 years, you could text Steve at 6:10 in the morning and have an answer by 6:12. That's not my reality anymore. I have a few more clients, as well as an organization to run, advisors to train, et cetera. That's not to mean that your questions aren't just as important. It's just mean my response time is now slower than it was. So what you can expect from me is a within 24-hour response. I have busted that with some folks. If you ask me a really hard question, I tend to table those so until I get back to you. And sometimes I bust the 24-hour self-imposed window I have, but that's what I strive to. That's what Candace and the other advisors, the rest of the team strive to as well, is to get your questions answered. You know that I bought a building for, middle of 2024. I do plan on, as soon as I can, going to 24-hour ops. So there will always be an advisor, Series 65 person on shift to be able to answer your questions. And that will help. That means when I and the other advisors, the team, come to work in the morning, there won't be a 50 long, to-do list of emails to answer. So that is all internal efficiencies that I need to work on and improve. I've got a vision for it. I just need to make it happen. Thank you for your patience, which is, I kind of hate hearing that as a person, but I appreciate it as a business owner. Yes, we are working on that. We know it's an area where we need improvement. Now, here's the book overview. Every quarter I go into detail, and that's about the only time I'm going to go into detail outside of when I'm talking with you with your personal account. So let's look upper left there, 49.3 million. We started the year at 50 million. We're sitting here 9 months into a slaughterhouse of sitting at 49.3 million. Well, we're in a bear market, so 20% across the board. NASDAQ's down closer to 30. There are some accounts out there that are all technology, the super aggressive, super long the accounts that are down that 30+%. However, those that aren't, we've used a couple of instruments, Buffer, King, some private equity offsets, if you will, to try to mitigate the downside, and also gotten rid of almost all the speculation. Basically, unless you make me hold your Roblox or whatever it is, your Tesla, I've sold it by now and moved on from it. So really, you're seeing core positions out there that are part of the bear market strategy, which I will show you a little bit later on. Further down that column on the left in the gray, you'll see what's our exposure. 83% assets under management. That's basic in your Schwab account. There are some folks at TD Ameritrade. That merger is supposed to happen. I put that in air quotes if you could kind of see it from my face, that it'll happen eventually, probably 2023. That's a big problem for them to solve, so it's going to take a while. AUA is assets under advisement, which are 401ks, thrift savings plan, 529s, other held away accounts. We do have the capability now. We partner with a company called Pantera, which is a third-party security firm that allows you to put in your credentials to like your E-Trade account. And instead of having to transfer your E-Trade account over to Schwab, it's like, no, I want to keep it. It's the same tax forms, whatever. You can keep it now. You don't ever give us the login. That would be a compliance nightmare. But basically, you go through a third-party API system to where they authenticate, and we're able to go in basically on a limited basis to go in and manage that account for you. That applies to 401k, thrift savings plan. If you have that stuff with us, you've already heard a little bit about it. There's going to be more to follow this week. That's kind of our initiative right now, is to get everybody onboarded to the new system. If you have any questions about that, or if you want us to manage a 401k thrift savings plan, let us know. Alternatives, 6% of the book, basically. The only things that are up this year, alternatives. They're not pegged to the market. So alternatives are often taking advantage of tactical opportunities that are out there. Blackstone is where we have most of our money for the alternatives. That is the right-hand column there. There is some money out in other places, farmland, venture capital, opportunity zones. If you want to, if you're tired of paying taxes, call me and say, Steve, tell me about the opportunity zone. I can't push it enough. But the pure private equity of Blackstone, they are the ones that take advantage of situations where there are distressed real estate or distressed equities or distressed anything. They have the war reserve to be able to come in and buy it on the cheap, buy low, sell high, which is what all of us are supposed to be doing. But they are benefiting and will continue to benefit in down markets or the mother of all recessions, if that's what happens. We shall see. Okay, the standard equities in the middle, or standard instrument investments in the middle, really reduced. I'm up to 10% cash across the book, and that's two reasons for that, and we'll get into investment strategy in a little bit. I'm okay with building cash here. If I built cash in your account, it's for a tactical opportunity to re-enter later back on. If I haven't, I think you're best suited to buy and hold through. So part of that's me judging your personality and tolerance for risk. The lower risk option, honestly, is holding all the way through. Lifetime investing is about buying cash producing assets and holding them and taking advantage of that. And if the price of them goes down, you buy more. That's investing 101. You'll see that here in a minute. So I built more cash because I do think the next move is lower from here. We'll talk about Jamie Dimon's word today. I think those are kind of funny in themselves, but I do have a large cash position, large in relation to the book, of large innovation in relation to what I've ever had in the business, and equities below 50%. So really a kind of shift away from the market while we're in these trying times, not with everything, just with some of your money to be able to capitalize on things lower. Okay, the top 10 holdings. I like covering these just so you could see. Pardon the typo in the top one. That's AAPL for the ticker for Apple. But Apple has always been our number one holding and will continue to be the number one holding. We're basically holding our Apple through the downturn because we believe that it is the best exposure for both a tech and luxury company, and must-have item, highly addictive position to change the world. So there may be a time where that changes. The iPhone 14, I have to agree with you, largely a flop, right? If you've seen the memes, here's Jimmy with the iPhone 13 and here's Jimmy with his iPhone 14. It's the same picture side by side. Yeah, there's really not much. I haven't bought one, and I always have the greatest and greatest, and I passed on it. So kind of gives you my take. But the company all around, when you look at the new watch, the new AirPods Pro, the new AirPods headphones that are out, our youngest daughter has a new set of those, courtesy of her loving dad. But there's so many ways to win with Apple. We're keeping it as the number one. Number two, buffer. That's basically an instrument to still stay invested in the market, but mitigate the downside. When the market's down, buffer's down, but it's down a lot less, right? So it's a place to space hold in your portfolio, so you still have the equity exposure in case you're wrong, which you have to always, you could be wrong, right? So if Jerome Powell wakes up tomorrow morning and says, you know what, no more rate hikes, I'm done with this crap. Market screams higher to like 10% tomorrow, right? I mean, obviously that you don't know what's going to happen tomorrow. So that's why we have buffer in there to mitigate the volatility. Amazon and Google, you'll notice that the three of the top four holdings are all individual stocks, but there's not any other individual stocks in the top 10. That is a very different portfolio allocation than I have had since I've been in business for the past 8 years. I used to say individual stocks were it. It's the place to be the most efficient. That's all you need. Game changed. Unfortunately, in 2023, you need to spread your money out and find ways to mitigate the downside. You need to have a lot of high dividend, high yield players in here, like number 5, First Trust Tactical High Yield Fund, kicking out several percent. Cybersecurity and cloud are both specific themes I want to hold through the downturn because they're too important. The Blackstone Credit Fund has been the best performing fund out there, and it's private equity. Dividend aristocrats, and the last one, the opportunistic fixed income, where there's trading going on inside of the fixed income space. Very different from how we've looked before. So that's why you're seeing that stuff in your portfolio, and that's why you're seeing large dollar amounts. That top 10 alone has lost a lot less than overall just, buy the SPY or buy the Qs and hold your portfolio through. That's why you've seen these large position moves, and, largely they're part of a bigger portfolio with some other positions in there, but they're all designed to do things of, look, the market's going down. It's to mitigate the downside, generate cash to be able to turn around and buy new shares while the prices are cheap. All right, switching to investment themes. Well, I will tell you every theme on this page I believe in. And every theme that has lost money this year is in red. So fantastic, right? So this is where you have to, as a manager, and that's where I will brag and say most won't. Most stick to their guns and just don't even listen. But when people are asking what was the bear market strategy or what is the bear market strategy, well, that was the first quarter. First quarter was getting out of a lot of this stuff, and go back and check your transactions, getting out a lot of this stuff and then going into safer, more high yielding instruments, whether they be fixed income or dividend payers. And, I know national defense is a good play. I mean, nuclear war is in the news, not like it's really knocking on the door, but it's at least being talked about. I mean, there's all kinds of stuff you'd be like, this is a complete no-brainer to put money into. You could argue the metaverse. I get that. Some people don't believe. Artificial intelligence. If you saw the Tesla robot running around the other day, $25K a pop, but I think it's coming, right? 5G, 6G, augmented virtual reality, all this stuff is coming. All of it is going to be a way to make a lot of money, not in the third quarter of 2023. That's the problem. So you have to get out or simply hold through. And if you hold through, I mean, you gotta have the pain tolerance for it. So what are we investing in? So you're like, okay, don't care about the past, don't care about the future. 2022 in that right-hand box going into early next year. Look, if you want into private equity, the minimums are low. You don't have to be, super mega millionaire to get in anymore. So if you're like, you know what, I want to learn more, reach out to me. I can send you the appropriate websites and you can learn more. BCRED is Blackstone Credit and BREIT is Blackstone Real Estate. They're not quite self-explanatory, but they aren't the most confusing things in the world. When you think of private equity, you think of like big cloaks and doors and, it's not. It's really, but you do tie your money up. So you cannot use money that you don't want back for the next couple of years. All the other stuff you're gonna see. The volatility and buffer we talked about. We haven't talked about JEPI and JEPQ. These are JP Morgan instruments that are specifically designed to use options to generate cash around the edges of a volatile market. JEPE is large cap. JEPQ is what they call the SMID cap space, which is small and mid cap. I like JEPQ a little bit better, but you may have both in your portfolio. Dividends, whether it's RDVY, SDVY, or King. Themes, I told you I like the two, cybersecurity and cloud computing. You won't move me off of those unless you stay Steve Sell, and then I'll probably still want to argue, but I've made it a point not to argue with clients too long. Anyway, and then the best of breed, obviously Apple, Amazon, and Google. If you want other stuff, we still have room for pet names in your portfolio. I heard a pitch here, hey, when are we going into Black Rifle Coffee? And I'm like, you know what? I love Black Rifle Coffee. I think their swag is the best. Their marketing is the best. It's a cool company. I believe I'm aligned with their beliefs personally. That's not a comment towards anybody else's beliefs. Not now. I know it was at 10, went to 30 some. Now it's down at 6. Too soon, right? There will be a time. It's not now. All right. The forecast. I will give you a 4-star review if you can name all 4 of those people. 2 are obvious, 2 are not. But while you're over there trying to see how many stars you get from Steve, here's the forecast. And this is really kind of why you've checked in. There are market economists everywhere. I do not profess to be my own self-made, self-born, Harvard-educated economist. I will never try to claim that. If there's a skill set that I will claim that I will say is better than others, it's resiliency and the ability to perform under pressure. And to be able to move with conviction. Obviously, that's from my fighter pilot background. I'm well trained. I'm well, rehearsed. I'm well disciplined in my actions, and I can move with conviction when decisions need to be made, regardless of what others are saying. However, I listen to others. I don't operate in a vacuum, and these are the 4 people that I listen to in varying degrees. And I will say the upper left one is Jamie Dimon from JP Morgan. I've never met him. I've met 2 of the 4. I've never met Mr. Dimon, and I have to say Mr. Dimon because I'm going to not say some nice things about what he said today on TV. But obviously, he's the chairman of JP Morgan. A lot of respect because he's the only remaining large financial institution CEO that was in the chair during 2007 through 2009. He's testifying before Congress in this picture, even though I edited it down significantly to fit it on here. Mad respect. However, I think the comments he made today about potential 20% to the downside, and we're going to have a major recession in the next 6 to 9 months. Part of the snarky person that's really deep down inside of me wants to say, okay, Mr. Dimon, and I have to say that because that means I'm about, that I say that instead of no disrespect. But, we've already had 2 negative quarters of GDP, which marks really the beginning of almost every recession we've ever had in the United States. That was the first 2 quarters of 2022. We just finished the 3rd quarter. We're waiting for the print, but it's going to come out negative. Everyone knows that. So that'll be 3 straight quarters. So Mr. Dimon, you're saying that the recession is going to hit 6 to 9 months from now. We need 2 to 3 more quarters of this to be able to say we're in a recession. I don't think it's a bad word. I think you just want to acknowledge the truth and then reposition and move on. So I'm a little curious as to now maybe his comments were taken out of context. I would almost have to say probably there's no way he could be ignoring the current the realities of 2022. But anyhow, he was all over CNBC today. Obviously, anytime somebody of this stature makes comments publicly to that level, it's going to crush the market, and it'll probably crush the market off into tomorrow and the next day. But again, I think the issue there is largely separate. I think he's comparing it to 2007 and 2009, and the system's just not that broken unless we break it as a government. All right, I'll get into the other people in a minute. Let's talk about my forecast. 2022 to Q3 review. Inflation was far stickier. So what changed, right? So you had inflation is a problem in Q1. We're going to raise rates in Q2. Okay, that's going to cause, or we're going to raise rates to combat the inflation. And then a couple quarters went by and we get into the Jackson Hole speech by Jerome Powell, who's the upper right-hand person there on the screen. And that was the, hey, the inflation has not broken yet. That's a problem because we've raised rates from 0 up to almost 3, somewhere in there. I don't know remember the exact number, but we've raised significantly, including a couple of 75 basis point hikes, and it's not breaking. That's a real problem. So that's why Q3, everything was fine until it wasn't. One of my favorite quotes. But July was fine, and then August and September hit. Lead balloon, right, straight down. So my retracement all the way back to the June lows, if you will. So the bear market rally I talked about in my videos this, in the past couple months, you can't trust those, right? Because nothing has changed. The inflation isn't breaking. We're raising rates. So anytime you see a rally, you can't think this is the buy the dip end all be all moment. It's just not. Nothing has changed. Russia, Ukraine, nothing has changed for the better anyway. You could argue daily headline, but it's still it's raging on. I thought it would last weeks. It's not. We're months into this and about to ready to hit the year point in a while. But certainly the rhetoric has gone through the roof, talking nukes and stuff. So to conclude there, Q3 in review, recession's here. I think we'll all look back and laugh in history that the U.S. government denied that it was in a recession after it had its primary recession signal on July 15th, and then wouldn't admit it because of the employment. I would say it's different, but maybe it's a different colored duck, but it certainly walks like a duck, acts like a duck, and quacks like a duck. So I think we're in the recession, and I think you're going to be smart right now individually, or if you're a business owner, or just kind of move with conviction on your spending right now in case it gets bad. Right? Okay. What lies ahead? Obviously, we're still going to have inflation. Maybe it breaks, maybe it doesn't. Rate hikes are likely to continue into 2023. So right now we're priced in. That bold comment there is 0.75%. So 75 bips. If you keep hearing that. Rate hike at the next increase, right? I will tell you who's saying that, and let's go to the lower left. That's Brian Westbury from First Trust. He's the chief economist. I think as far as just sitting and listening to somebody, he's the one that if you were all put yourself in the church, and if you're the one sitting there listening and you're like, amen, 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 right? You agree with everything somebody's saying, and you should never agree with everything, but for the most part, the stuff he's saying, I think, is spot on. And he's saying we're going to have at least one more 75 basis point hike, and that the Fed is not going to let inflation win. They may destroy everything else, but they are not going to let inflation win, which is kind of scary, right? That can spook the market too. But so something else may win, but it won't be inflation, right? And when you look at Chairman Powell in the upper right and say, okay, his legacy is right now. How he handles this is right now, right? All the good he did in the past, that's all long gone. Who cares? Forgotten, right? The Tom Brady, it's like, who cares what happened in the past? It's all what happens right now, right? So his legacy is right now. So I don't think he's going to let inflation win or back down. So in that case, back to the bullets of, the Q4, Ukraine, Russia continues on. Secure 2.0, I think will actually find footing. Other than that, no significant tax reform into the elections, but the weight of the election, I thought, would bolster the market. I do not think I think it's a force on the market, but it pales in comparison to the other two. So it's still going to be inflation and rate hikes. And then below that, probably Russia, Ukraine, and below that, the change in government slash, the benefits that a government gets if the Republicans win the House, and then there's gridlock in Washington, stability in the markets. I think that's just going to be overcome by events. Okay, 23 forecast: rate hike, overshoot to the upside, or wait and see mode. So here's what's going to happen with rate hikes: is there's the Chairman Powell who says, I'm not going to. I'm not going to move off of my stance. We're going to beat inflation. We'll do whatever it takes. Boom. That means we're going to do rate hikes until well past when it was necessary, because lagging indicators, right? You raise rates every 6 weeks, you get the inflation indicators. And by the time the thing's dead, you've way overshot. We've done that before. We've done that in 2018 for a month, and then walked it back fairly quickly. If we overshoot, and that's kind of the best case for investing, because that means the market gets hammered. And you're like, Steve, what are you saying? No, if it gets hammered, it means it goes lower. Yes, there'll be losses in the meantime, but that's where you can scoop up and make a mint at the bottom. So, and that's at 2007 through 2009, 50%, 53%, I think, from peak to trough. Yeah, we're already at 30 in tech. So could we see 50? We could. Well, it makes it easy to invest there, because when things are down 50% and, folks are like texting me, Steve, what should we buy? It's like, why? I'll say why. I won't even waste the time to say yes, because I'll have it why, because I'm answering so many people and I'm buying at the same time, right? The harder scenario of the two is the second part of that bullet there in 2023 forecast, is the wait and see mode. This was the 1970s, and I'm not a historian and I'm not an economist, but from listening to these guys talk, if you look back to the Fed, and this is Joe Zeidel in the bottom right, who's from Blackstone. I met him personally not too long ago. He was at Franklin Barbecue here in town and talking about this. And that's when I came back and I did that morning brief where I said, I just got a very dire forecast from Blackstone, and it's made me reevaluate everything. And he's like, if we get into a 1970s Fed, maybe we raise, maybe we don't know. We're going to wait till the day of, and then we'll let you know. Then the volatility goes through the roof, because that scares the crap out of everybody. So knowing what's going to happen scares you because you don't like it, and not knowing what happened really going to scare you, right? So it's like kind of the old days of Saddam Hussein. We don't know, we don't like that guy. We need him out of power, but then if we take him out of power, who else are we going to get? That sort of mentality. Both of those scenarios are bad, which means the markets are going lower. And then the worst case that Joe put out, and he very eloquently, so I will miss the mark on explaining it, but he's like, there's inflation and rate hikes. They're not correlated one for one. There's no guarantee that raising rates will cause a decrease in inflation. We've done enough money printing in the past 3 years. You've heard all that through mainstream media, to where we could do what normally would fix the problem, and it's still not fix the problem. So what then? And I mean, he said, I'm listening. It's literally Thursday night. I'm eating the best barbecue I've ever had in my life. And it was like, whoa. He goes, what then? What do we do then? And that was not good. So it made me reevaluate that. Yes, you can have cash in your portfolio. I prefer you not to go to all cash, but certainly I think we're going to go lower before we turn around and go higher, and there could be much lower. Okay, moving on to 24. What's in the out years? I think this will all play out. Look, I don't have a crystal ball, but looking at all of the factors and the four voices you have on there synthesized through me, I do think we are going to cause a 2007 through 2009 period. And largely we did it to ourselves this time by, printing a lot of money, sending it out to everybody, causing the inflation, and then crushing the economy, self-induced, both these rate hikes. Like, what are we doing? Could we have done this dumber? Right? It's like, show me a dumber scenario than causing the problem. And then, so bad. So where the cure doesn't work, but we're sticking to the cure no matter what. The case that was put to me by another person was saying, so what, if inflation's a cancer and Fed rate hikes are the chemo, what if the chemo doesn't beat the cancer and it's already got all that other, negative side effects? It's just like, this could be bad. Good news for the US, we will snap back out of it just like we did in 2009. And I think once it's all over and we're back on our feet after we've put ourselves to our knees, then it's going to go screaming back higher. My case in point for that would be at the very bottom when I say decade summary, because I don't know when it's going to happen, but there's a huge upside on the snapback, focused alpha similar to March of April 2020. If you were with me back in March of 2020, it was a holy crap, that happened so fast. We're moving 7% on a daily basis up and down as the markets are trying to price in what a pandemic closing the economy is supposed to look like. The only thing I knew for sure is when it overshot to the downside on March 23rd. Okay, as a day early, it was 24th when we actually bought them, but it was the sometimes, I mean, the easiest move in investing is just to overshoot to the downside where it's a no brainer of like, okay, yeah, now we're going back higher. We aren't close to that. If you think we're close, if this is the worst market you think you've ever seen, you need to flash back a mighty 2 years because it was worse than this. It was down 35%. So we're getting close. The pain feels worse because then it was like a broken arm. Now it's like the cough that won't go away, right? So those are the differences. But I do think, once America's back on its feet here, then we will be good going forward. To summarize down to the bottom, traditional returns of 10 to 12%. That's the likely. That's not the, the 20% that we had for a decade, coming out of 2009. I do think if we crush the markets and then come back out of it, you're going to, you'll see some 20% years for sure, maybe a 30% year that first year. So that's why you kind of don't want to be in cash because you have to get back in at the right time. But still focused on a few firms. And then the time for speculation was when the market recovers, right? So I know there's a lot of people out there say, I have this niche company that I know about and I think they're awesome and they're going to change the world. The time to take all that risk really is when the market's on a big upswing, right? Because then money managers like me, except for like the, thousands that are, manage a bigger book than me are out, we're all buying, right? We're trying to find something to buy. And that's when the market screams higher, when it's just like, we got the all clear signal and we're going higher. Okay. A few updates for the company. Since I have you on here, we do have a total of 4 advisors now. Even the newest is David from Dallas. We also have Joel, which I can't remember if I introduced last time, but you can see his picture over there on the Meet Our Network. You know about Jaden if you've been here for a while. Started out as a servicing advisor. He's actually taking clients now. All while he went, started college down at UT. He's immediately interviewed and was picked up instantly. I can't say instantly. With very little to do, he was able to join some significant investing clubs down there at the university because he's a licensed advisor at 18. Very impressive. So he's taking new clients too. So we're growing. We're helping more people. If you have referrals, send them in. We'll kind of find the right home for them because all of us are different in the way we're able to service the clients out there. But very proud of the team. Also, our insurance person licensed here in Texas, even though he lives in Scottsdale, is David. If you want to buy term insurance, come through us, see David. There's no money exchange or it's not a dirty relationship. There's no commissions or anything. I don't see it. We don't see a dime. He just services the insurance needs if you have them. So reach out. Okay. Also to the right, you can see we have a new pamphlet there. This was kind of like, I feel like it's kind of like a relationship going Facebook official. When you have a fully produced 12-page handout that you can, put in people's hands when they talk to you, makes you feel like you're finally there at the top of the heap, right? But if you haven't seen one of these, it's basically thanks to Jaden and Candace who put this together. It explains everything what we do and also shows you some cool pictures along the way. Couple of themes there by showing you the pictures. It means like, yeah, we're on it. We're on the situation. We won't always make the right moves, but we're monitoring the situation. We've got your back. So if you want to see one of those, if you want one of those, just text me and I'll mail it to you. Okay, if I don't see you before then. Okay, what are some real topics to discuss here? I know I've gone a bit long. We're past the half an hour point. Folks like to ask me, what's our new strategy? Well, you're into the bear market strategy, and we have been for a couple of quarters. We started in first quarter of 2022, out with the speculative holdings, focus on best of breed, and now we're holding. If you want, you can buy along the way. Well, any buying you've done along the way, I know has gone down further because we're at lows for the year. However, if you look at that investing 101, if you took everything aside from forget this year and forget, say you were going to go and you had 5 minutes or 2 minutes. How about that? Say, show up at the high school, you're a respected model citizen who's done well in your life. Come down to the high school and tell these kids in 2 minutes how to invest. Well, after much angst, right? You'd probably look some stuff up and think about it and, really trying to put it down on paper. What do you do? So, and I will expand it a little bit more, but this is exactly what I would say to high school kids is it's all in what you buy. right? You're going to leave high school, you're going to go into the trade world, you're going to go to college, and then on into the corporate world, or wherever it is, you're going to go out, you're going to go forth in the world, you're going to make money. How you choose to spend your money shows you what type of person you are. And when you think middle class and below, and these are stereotypes, I got that, but for conceptually, bear with me, middle class and below, you are buying stuff. The stuff that's on the shelf at the Walmart, stuff that's on the stuff that's on Amazon, it pops up and you buy it and you're like, that's stuff. That is buying stuff, right? And you load up on stuff. That is like middle class and below. That's like the move, right? And then you get to upper middle class and you actually take a downturn a little bit. Then you start buying fancy stuff, which are called liabilities. Now, if you buy a stuffed bear or a little thing that sits on your counter or whatever, or so, some wrenches, or may all have some, it's stuff, right? And they may have some utility, they may not. But when you buy like cars and boats and airplanes and stuff, then you're buying liabilities, right? You're buying things that actually cost you money. So middle class and below buy stuff. Upper middle class buys liabilities because they think that, nobody will ever have to answer for all that. So, right. So they're just burning their money. But the rich, the people that are either currently rich or on their way to being rich or wealthy, are investors. They acquire assets. And they acquire assets, acquire assets is one thing. And then assets that generate cash flow are another thing. And, you can't go on TikTok with, Grant Cardone or, Bradley or any of these other folks that crush TikTok and crush, Facebook and the other, everywhere. You already see them all the time. And they're like, cash flow, baby. That's their thing. It's not mine, but it is the thing, right? You buy an asset and you hold it for a long time. Think real estate. You buy it, you hold it for a long time. You don't give a crud about the ups and downs. You don't even consider it, right? Same thing with investing, right? You buy the assets, you put them in your portfolio. Obviously, the more speculative don't have dividends, right? They're not kicking off cash flow. But if you're buying, cheese and diapers, right? The Kraft and Heinz and Procter and Gamble, just buy it and hold it literally forever, and it kicks off more cash flow, over your lifetime than you ever paid for the stock. So who cares if it's up or down, or, Fugazi, to quote, Wolf of Wall Street. But I mean, that's investing, is buying assets. It's not, oh, the market's down for 9 months, I'm going to now start selling my assets to sit in cash, which doesn't do anything. So anyhow, investing 101, you buy and hold and acquire over a lifetime, and you just sit back and benefit from it. There was a study done years ago, and of course there's a million studies done. So, when I say there was a study done, okay, blah, blah, blah. Right. But honestly, it came out, it's like, who's the best, who are the best investors ever? And maybe they had an agenda when they wrote this, but literally, they were like 100% of the time it was dead people have forgotten accounts, right? People that just, passed and nobody knew it. The account sat there and nothing changed, and it just sat there and acquired and reinvested the dividends, and they did, they whooped everybody, right? Because they don't have emotions and thinking about all of this, do I move to cash and what percent, and oh my gosh, and what did Jamie Dimon say today, or Steve for that matter? It's okay, I got it. I'm going to buy and I'm going to hold, and I've got nerves of steel and a long-term perspective. So you're never wrong to buy and hold. If you want cash, I support you going to some cash right now, but there's risk in that. You have to go tactically to cash, tactically back out of cash. Anyhow, there's more to it. All right. The new contracts that you've seen, and I'll try to wrap it up here without getting too details, are tied to a risk number. Everybody has a risk number, and we use from 1 to 99. The portfolios on the next page will kind of show you the groupings that we use to compare conservative to aggressive and all that. If you want to walk down in risk number to more conservative, generally with more conservative portfolios that we have set up, you are buying more of the either income producing fixed income assets, or you're buying more of the dividend growth. So if you're like, hey, Steve, let's talk some dividend growth names, it's like, no, let's talk a whole bunch of dividend growth names by going in the dividend growth funds that specialize in that. So where I spent most of my 10 years of getting to this point, 8 years, getting to this point of focusing on individual names. On the downturn, you need to spread out and just kind of find as much cushion as you can for the downside that's kicking off cash. Okay, so if you have any questions on that risk number, you're going to continue to hear that. There's a risk number and a risk range, and it's all tied to your new client form and your contract, and you can talk to your particular advisor about that. Okay, I'll skip right to the bottom. Well, let's talk about the left. What do we do for you? We make you as much money as possible within that risk number. And we coach you to avoid making mistakes. And if you do, we mitigate the financial damage. Well, that brings us to the bottom. Should you go more conservative to include CDs? That's right for a lot of people. I would say you either need to go more conservative or to CDs for two reasons, mental or physical health. Don't do it for math, because math will always support buying and holding and just waiting for the snapback, i.e. I slept through the year and what happened to my portfolio. It's like, oh, cool. Look, it's back up again. And you won't even have known that it dropped, 20% or whatever. Right. Or 2 years or however long it takes to kind of snap back out of this. So, yeah, mental or physical health are reasons you should move. So, mental health, is it stressing you out? I get that. It can wear on people. Then yeah, let's get more conservative or put some to cash. Obviously physical health, if it's wearing on you that much to where it's affecting you physically, then yeah, definitely we need to back this down so it doesn't end your time here on the planet earlier. So let me know if either of those is the case. And then last, if you want to go to cash and part or in whole, just realize that you are leaving investing and going into more trading and speculation. You're like, well, Steve, you just said, the market's going lower. It's like, well, I don't have a crystal ball. Like I said, Jay Powell could tomorrow morning say no more rate hikes. We're done. Or the next inflation print numbers at 2.8. Well, obviously the rate hikes would stop and the market would go wham, and right back 10% higher. I mean, and we have no control over that, right? So you are speculating some. So you may cost yourself money by going to cash, and you're like, oh, right, I'm going there because it's conservative. It's like, well, maybe not. So anyhow, lots to think about there. Okay, I'm not going to cover this at all, so you can just go ahead and click pause on this if you want to know more. But there's a bunch of words on how we service you. That's all in the brochure now. The bottom line is there's 10 examples of portfolios from conservative to aggressive off to the other side. Those are ranges. Again, the more conservative you go, the more cash flow it generates to be able to buy more shares while the prices are down low. So look right to the bottom. Generates conservative portfolio that is going to go down versus cash that's going to sit there. It's like, well, the conservative portfolio generates more cash to buy more shares. So at the end of this, you have more shares. So then when it does go back up, you're not rebuying shares higher. You are simply having more shares when it goes back higher. So more cash flow generating assets at a cheaper price. Okay, that's all I'm going to cover there. I see one comment in the chat. So let's see what our question is or comment. 2020 had a different administration. Okay, yeah, I agree. So politics, good question, not in the form of a question, right? So thanks for submitting that. Regardless of your political persuasion, both sides are going to come and go. Locally, state-wise, no matter what state you move to, it seems none are safe, right? Or nationally, there's a natural ebb and flow there. The good news is there's, it's only 4 years, which can seem like a long time. I get that. Or 8. Yep, I got that. But, with term limits and things tend to overreact, right? Up and down. One of my favorite leadership mantras from the Air Force, I was told by one of my mentors back in the day, is, about Air Force leadership is why simply react when you have the time and energy to overreact, and which is satirical. But that's what we do in a country. As a country, we'll react one way and then react the other. It is what it is. There's elections, get out the vote. You've got one. So go forth, trust the system. I know that's hard to do in the past, some of the, data points from the past few years, but you do have to believe in the system. Otherwise it's all broken. Right. So good question. All right. Any other questions or comments before I let you guys go? All right. Well, thank you so much for tuning in. Again, I'm Steve Ankerstar, CEO and founder of Ankerstar Wealth. That's what we have for you for the upcoming quarter. And again, more pain ahead, but we're going to do our best to navigate it through you through it for you with our team. So thanks for listening in.